In today's video, we are going to talk about how to avoid a bad deal when it comes to starting a whole life insurance policy. We'll talk about someone who is specifically interested in the cash value benefit and they're looking to fund a policy with $50,000 per year for 10 years. So that's a total of $500,000 that they want to get into the policy. And again, their interest is the cash value. Looking at the core benefits of the cash value, they are what? We talk about them frequently. The cash value is a safe, liquid, and tax-free area to position money. Tax-free if we don't mess it up by triggering a modified endowment contract or another taxable event, which we have videos that provide education around that. So we've got his main point of interest here, and here's what he's originally proposed. So we've got an individual who's 40 years old. We know what he's interested in, $50,000 per year, and what he has shown is a policy that of that $50,000, he's got $18,000 going toward the insurance premium, and the rest is going toward this guy, this PUA rider. PUA stands for paid up additions. This is a great way to maximize the cash value of a whole life insurance policy. So he's got $18,000 going toward the premium. Here's the thing to be aware of, and this is what a lot of people are proposed when it comes to whole life insurance policies, is that the premium piece does not build any cash value in the first and second year of a policy, especially if it's more of a traditional life insurance policy. So to see a quick example, here's what the illustration will look like. So we've got a lot of columns. Some will refer to this as looking like stereo instructions because we've got a lot of stuff going on here. Here's what to look for when we look at these illustrations. Here's how much I'm paying in per year. So I've got a net premium of $50K per year for 10 years. Here's my total payments over time. I've paid in $500,000. Here's my money column, net cash value. And then I also have the net death benefit. The death benefit is the amount that is paid out income tax free if I were to die. So what do you notice here? Year one, you pay in how much? $50,000. And how much do you have available to you in terms of cash value? Because this is your money column, the money that you have access to. You can typically loan up to 95% of whatever that cash value is through a policy loan. That's about a $20,000 hit in the first year. You pay in $50,000, you've got approximately $30,000. If you look at your total payments over time, how long does it take to get your money back? In this particular example, just about 9 years. Often in designs like this, we see the break-even point, which is the first year that your total cash value exceeds your total payments. That's what the break-even point means. It typically falls somewhere between 7 and 10 years with designs like this. An ideal design from a break-even point standpoint, meaning if cash value is your goal, should typically fall somewhere between 3 to 5, sometimes 6 years, but that'll be in the tail end of everything. I should see a break-even somewhere between 3 to 5 years in most cases, if it's set up with a minimum insurance expense, meaning, again, the cash value is maximized. So with this particular policy, why the cash value is less, if you want to know the why behind it, the reason is because of that $50,000, there's your insurance premium. That insurance premium is not showing up in cash value in the first and second year. Beginning year 3, that premium does begin to come back to cash value, but in the first 2 years, I get nothing. So what we're going to look at here is the exact same product, this Whole Life 99, but set up a little bit differently. So what we can do with the policy, and here's the fun part that a lot of people are not aware of, I can keep my out-of-pocket exactly the same, but what do you notice here? So we've got an alternate proposal. Still $50,000 going into the policy, but of that $50,000, now we've only got $5,000 toward the premium and $45,000 toward PUAs. As a result, the piece that builds zero cash value in the first 2 years is what? That's reduced to the minimum. What we want to do is reduce that insurance premium as low as we legally can based on the insurance company and also IRS limits. So we are reducing the premium, which will also reduce the initial death benefit, but there's ways to still keep that high with a term insurance rider And this will also have a relationship to this term, MEC, which stands for Modified Endowment Contract, which is important to be aware of because it prevents a taxable event with a life insurance policy. But again, if your interest here is maximizing the cash value, what we want to know is by reducing the insurance premium and getting more money into the PUA rider, that should give me more in cash value immediately and long term. So let's take a look here. We're going to look at the same product, just with the money redirected. And what do you notice here? Well, your first year cash value, instead of $30,000, is nearing $42,000. Your break-even point here with this product is year 6, which is on the tail end of what it should be. You're going to see an example with more cash value up front in a little bit. But same product, what we did was just reduce the premium and direct more money into this PUA rider. A great method to maximize the cash value. So let's look at the two side by side here. This will be interesting. So here's our first policy, the traditional policy that is pitched as a high cash value policy. And what do you notice? On the left, in red, you've got your base premium at $18,000, then your PUA payment at $32,000 for a total of $50,000. There's your first year cash value. This is exactly what we looked at on the detailed illustration. What's highlighted in yellow represent your break-even point. You're very close in year 9 in this particular example. So let's look at the second example we saw, which is the true high cash value life insurance policy. So what we did here was lower the premium. If we go back to that illustration, you may recall it was actually a little bit less than $5,000. It was $4,500 and change. I made this $5,000 because we have the premium and also there's term insurance attached, a term insurance rider, which we've got other videos that provide a full breakdown on the purpose of that rider. The term rider is an expense that we do want to attach to a policy like this. What it does is increase the death benefit, which if someone says, I don't care about the death benefit initially, where the death benefit's important is here, has a direct relationship to that MEC limit, which again prevents a taxable event with a life insurance policy. The fun part about the MEC limit and policy design is we can set it almost wherever we want when we're first setting up a policy. So we've got some flexibility there, which is a lot of fun. But the same product here with the exact same insurance company, the same individual, if this is you, in both proposals, your out-of-pocket is identical. However, which one gives you more value from start to finish? The one on the right with the reduced insurance expense. Immediately, you've got $12,000 more. And when we look at the cash value difference, what happens as time passes? Even after we stop funding? Well, you see the benefit become greater and greater as the years pass. Pretty neat, isn't it? So with this said, I would actually look at a different product. So what we can look at is an option that shows the same company. So let's look at the same company, but a different product. And again, the purpose of this is to avoid a bad deal because the first option we looked at was more of a traditional policy where that premium does not show up in cash value in the first and second year. So what we're going to look at is a very similar product, but a product where the premium does not show up in cash value in the first year only. Meaning year 2, the premium begins to come back to cash value. So if you're a policyholder, if you're putting in $50K per year or any dollar amount, what does that mean for you? You're going to see more money come back to work for you sooner rather than later. Your break-even point will be earlier. So let's take a look here. What we'll look at is first, this L99 policy. So this is the policy we just looked at. This was the high cash value policy. Same exact option here, breaking even really year 6 when we look at it. Now, let's look at this. Here's an L95 policy, these different terms. Same company, very similar products here. The designs are identical. Here's the difference. This policy, with respect to the base premium, that doesn't show up in cash value in the first year. So when you look at year 1 with these two options, Are they the same? Almost, aren't they? You're off by what, $150 with $50,000 going in? Look at the total death benefit. Those are identical with the way we design these policies. We wanted to keep everything as close to an apples to apples comparison as possible. What do you notice beginning year 2 though? Now the difference, instead of $150, is $4,400. And what happens as time passes? Well, the cash value difference becomes more and more. Now, is it a huge difference as time passes? No. When you look at the two side by side, they're very similar. But how I often approach this, if this is me personally, if I'm getting more cash value up front and more long term, why would I pick an option that doesn't provide that? Or another way to explain it, or another thing to consider, is if I'm sold this policy, the L99, which is a decent policy when it's designed correctly, if I find out about this alternate option after the fact, how would I feel? Personally, I would just kind of scratch my head a little bit and say, why didn't I see this? Was there a reason we didn't look at it? They're not that different, but I am curious because I've got more value here. And when these policies are designed equally, by the way, the commissions are identical as far as how commission rates and such are paid. So identical in terms of commissions to the agent, it's just having the awareness to show the different options here. This one could potentially look slightly stronger if I wanted to fund it for a long time, meaning if I'm going to fund both of these longer than 10 years, something like 20 or 30 years or longer, that's where that L99 would look slightly stronger. What you might see is this column flipped. So there won't be much of a difference, but if I keep pumping money into it, that L99 might look slightly stronger. But again, we're looking at the exact same insurance company here. So all things are equal. So that is an overview of the different products. There's even another version, not to show too many options, but here's a nice option that gives individuals more cash value up front for those that are interested in that. This also has stronger guaranteed values if we're very, very conservative and we want to see the strongest guarantees possible. But in order to avoid getting a bad deal, what's the most important thing? Well, what I would say in terms of importance, the first thing would be awareness. I want to be aware of the different ways that a policy can be set up, specifically this guy right here. Am I aware that I can reduce the premium and get more of my money toward this PUA rider, which gives me more money in cash value from start to finish? And this is especially true when you look at the guaranteed values. But awareness, that's one of my favorite words. Awareness is key. Do I have awareness on how a policy can be set up? And then the second thing is seeing more than one option. And it can be with the exact same company, like what we just saw, just different products there, different variations. This way I see how a policy can be maximized up front, long term. Maybe I look at a second company as well. Just seeing enough options up front. I don't have to look at 10 million options, but enough where I can make a decision that I feel confident in, and I'm not gonna have to worry about some situation that comes up later where I feel like, why was I never shown this option? If I'm going to just inform someone in a very, very short period of time, if they say, hey, I'm going to speak with this agent, what should I be asking? What should I be looking for? I would say, one, make sure you consider one of the 4 major mutual companies because we've seen proof of performance from them. And then 2, ask how low the base premium can be with respect to the dollar amount you're paying in. If you're paying in $50K, you'll find with those major mutual companies, a lot of times you can drive it as low as 10%. Some are a little bit lower, some are a little bit higher, but ask how low it can be. Knowing that it's close to 10%, if you get an answer, you can typically drive it as low as 10%. You know the agent has the knowledge and also is willing to set up a policy like that. If they don't say that, or you get some answer that doesn't make sense, I would ask again. And then when you see the numbers, knowing what to look for just based on what we went through in this video, hopefully that will help as well. So I do hope that this helps. Let us know if you have any questions at all. Feel free to leave any comments or questions below. And as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you, If you have any questions, please leave them in the comments below. And as always, I hope this helps.